Okay, Nike reporting better than expected earnings for its fiscal fourth quarter. Tigress Financial's Ivan Feinseth joins us now with the results. Ivan, big picture. 4 out of 5 quarters, they have beat on earnings per share and revenue. What's your big takeaway?
Well, first of all, it's mostly as expected, some headwinds in China, but the overall strategy of focusing on large accounts, pulling back from some small accounts, and the company focusing on their own direct-to-consumer sales continues to work, and we're seeing the results. And again, we're seeing confidence in the outlook with the announcement of a new $18 billion share repurchase. So companies will continue to return cash to shareholders as they have confidence in cash flow and have more than enough cash to meet their other needs as far as capital investment. And we see a great picture here, especially the increased confidence in the outlook as indicated by the new share repurchase authorization.
Ivan, we know China is critical here for Nike's success. Taking a look at those numbers, $1.56 billion in revenue during the quarter. That's down 19% year over year, slightly missing the street's expectations. Yet it seems like investors are able to shrug that off. Why?
Well, because China has a zero COVID tolerance policy, and the minute they start to get an outbreak, they go to shutdowns. And we've seen over the past 3 months rolling 100% lockdowns where the factories are closed, consumers are restricted to stay at home and are not even allowed to go out. So, I mean, this has China is the world's largest market for everybody. And when those markets shut down, it is impactful. However, strength in other areas, strength in Europe and America has overcome that. And when their consumer is actually shut down from participating in retail, it eventually comes back. So this is only sales, in my view, that will get pushed out to the future as China, we see these rolling reopenings.
So Ivan, is it fair to say that you think the worst is behind them, at least when it comes to some of the deterioration in demand that we've seen from China because of the lockdowns you were just talking about?
Yes, because the overall picture continues to highlight the strength in the consumer willing to spend on athletic apparel and athletic footwear. And we've seen that with Lululemon, especially high-end apparel, high-end athletic apparel and footwear. So the market is there for Nike. Nike has extremely strong brand equity that resonates with the consumer, and all of their strategies and their investments in further penetrating the markets that they continue to focus on are working.
I want to ask you about inventories. Obviously, something we've seen a lot of retailers struggle with. What are you watching there in that space for Nike, and can they withstand some of the losses that some of these other retailers have struggled with?
Well, I think Nike's pretty well capitalized. They're the dominant if not one of the dominant companies in athletic apparel and footwear. I like when companies have inventory because there's a bigger opportunity to lose sales from not having the inventory than any issue with excess inventory. And they do manage their inventory well and price and merchandise well. So I don't think inventory is an issue. I only think the problem in the overall shutdown that has been caused by the pandemic has impacted everybody's inventory. But Nike is an innovative company and seems to have managed their supply chain well to have at least enough inventory to meet overall demand. And demand, the most important thing is demand. You can always manufacture more products. You cannot manufacture demand.
And there is an enormous demand for athletic apparel coming out of COVID. You look at the stock price, it was trading $179 in November. And even with a slight pop after hours, $111. Does this look like a stock that's on sale for you, Ivan?
Absolutely. I mean, the market has had a tough time this year. So far, the first half of 2022, we've seen the worst down sell-off since actually the first half of 1970. So between the war in Ukraine, the pandemic, the rise in oil prices, which, by the way, the biggest concern is the increase in oil prices because that does affect consumer discretionary spending. It also does affect input costs to a lot of what Nike makes. But even with the almost doubling of gasoline in a little over a year, demand overall remains strong. So I think that's a positive sign.
Ivan Feinseth, always great to talk with you. Tigress Financial Partners Chief Investment Officer. Thanks so much. Again, Nike shares moving to the upside here in after hours trading.